Learn the fundamentals of swing trading and 5 of the most popular swing trading approaches and tactics. Stock Monster has videos on financial education, financial independence, stock trading, the stock market, and dividend stocks that will help you better understand how to earn additional income and live a better and safer financial life. Swing trading is a type of trading strategy that focuses on changing price movements over short time frames. Swing traders use these tactics to profit off of price swings in the market. Trading positions are usually held for 1 to 6 days, though some might be held for several weeks if the trade is profitable. Swing traders use various technical indicators to identify patterns, trend directions, and likely short-term trend changes to uncover trading opportunities. While numerous swing trading strategies are available, just a few have shown to be more profitable in the long run. Because psychology plays a role, this will be different for everyone involved, and all of the strategies should be used in conjunction with a strong money management strategy. We've put together a list of 5 swing trade methods that you may use to spot trading opportunities and manage your deals from start to completion. Apply these swing trading strategies to the securities you're most interested in to locate ideal trade entry points. Fibonacci retracement. Traders can use the Fibonacci retracement pattern to identify support and resistance levels on stock charts as well as possible reversal levels. Stocks generally retrace a specific percentage of a trend before reversing, with the Fibonacci ratios of 23.6, 38.2, and 61.8%. You can identify potential reversal levels. However, most traders frequently check at the 50% level since stocks tend to revert after tracing half of their previous rise. Suppose the price in a downtrend retraces and rebounds off of the 61.8% retracement level, functioning as a resistance level. In that case, a stock swing trader could open a short-term sell position to exit the current sell position for a profit. This allows the price to bounce off the 23.6% Fibonacci line and function at a support level. Support and resistance traders. You can design a profitable stock swing trading strategy on support and resistance lines, which are the cornerstones of technical analysis. A support level on the chart is a price level or area below the current market price where purchasing pressure is strong enough to overcome selling pressure. As a result, the price decline comes to a halt and the price starts to climb up once more. A stock swing trader would try to enter a buy trade with a stop loss below the support line on the bounce off the support line. Support is the polar opposite of resistance. It denotes a price level or area above the current market price when selling pressure may outweigh buying demand, forcing the price to reverse its upward trajectory. In this example, a swing trader could enter a sell position on the bounce off the resistance level with a stop loss above the resistance line. It's vital to remember that when price breaches a support or resistance level, the level flip rolls. What was previously support becomes a resistance and vice versa. Channel trading. To use this swing trading method, you must find a stock showing a definite trend and trading within a channel. When the price bounces off the top line of a channel drawn around a negative trend on a stock chart, you should consider establishing a sell position. It's vital to trade with the trend when using channels to swing trade stocks. So in this case, where the price is in downtrend, you'd only look for sell positions unless the price breaks out of the channel, rising higher and suggesting a reversal and the start of an uptrend. Make sure to subscribe to the Stock Monster channel for more videos like this one. 10 and 20-day SMA. The use of simple moving averages, or SMAs, is another one of the most common swing trading approaches. SMAs smooth out price data by generating a moving average price that can be used throughout various periods. A 10-day SMA, for example, calculates a new average each day by adding the daily closing prices for the previous 10 days and dividing by 10. Each standard is linked to the one before it to create a smooth line that helps to reduce noise on the stock chart. The length, in this case, 10, can be used with any chart interval, from 1 minute to weekly. SMAs with shorter periods react to price fluctuations more quickly than those with longer periods. Let's say you apply 2 SMAs of this length to your stock chart with the 10 and 20-day SMA swings trading strategy. When the shorter SMA crosses above the longer SMA, a buy signal is generated, suggesting the start of an uptrend. When the shorter SMA crosses below the longer-term SMA, a sell signal is generated, as this type of SMA crossover indicates a downward trend. MACD crossover. The MACD crossover swing trading strategy is a simple approach to spot stock swing trading chances. One of the most utilized swing trading indicators for determining trend direction and reversals is the RSI. The MACD comprises 2 moving averages, the MACD line and the signal line. And when those 2 lines cross, buy and sell signals are generated. A bullish trend gets signaled when the MACD line crosses above the signal line. This is when you should consider initiating a buy transaction. If the MACD line crosses below the signal line, signaling a sell transaction, the trend is predicted to be negative. Before exiting the trade, a stock swing trader would wait for the 2 lines to strike again, creating a signal for a trade in the other direction. You should try out these methods and see which one makes you the most comfortable. Whatever you do, don't put a considerable portion of your account at risk. In other words, make sure you're not gambling with the money that you need to survive. If you're searching for a long-term investment, you should definitely consider swing trading. Swing trading is all about removing the day-to-day stress of day trading and focusing solely on longer-term trends. It allows you to let the market work for you while only checking the market once in a while. Make your money work for you, not against you. Remember that someone who is good at investing can profit and benefit. Thank you for tuning in. Leave a comment below for video suggestions. See you all in the next one.